Hi, and welcome to another video by 22nd Century. We are a small nonprofit out of Austin, Texas, and we, the authors, Michael Barba and Anna Schmidt, together with our editor, Tamara Strauss, put together nonpartisan and data-driven studies on public policies in order to show you their trade-offs, so that whether you're in favor or opposed to any given policy, you'll understand both its costs and its benefits. Today we're going to look at the estate tax, which is defined as a tax that's levied on a dead person's wealth before it's distributed to his or her heirs. For this reason, some have called it a death tax. Now, why should we care about the estate tax, you might ask, since it only affects the wealthy and usually, therefore, a minority of people? Well, the short answer is that many issues only affect a minority. For example, the percent of individuals who are murdered each year in the U.S. is only about 5 in every 100,000, or about 0.005%. The percent of homeless is about 1 in every 1,000, or about 0.13%. People feel very strongly about same-sex unions, either for or against, and yet only about 5 in every 1,000 households has a same-sex couple residing in it. People also feel very strongly about education. They wouldn't want a child left behind simply because they have a developmental delay, yet this circumstance only affects about 7 in every 1,000 kids. So clearly Americans don't form opinions about specific issues simply because a minority is affected. With that said, we can ask, where did this tax come from? Well, the estate tax has a long history in the U.S., which began in 1797 when it was used to fund a war with France. It was then repealed in 1802 when that war ended. The U.S. government used it again in 1862 to fund the Civil War and repealed it again in 1870. It was levied a third time in 1898 for 4 years to fund a war with Spain. Each time, the tax was repealed when the war that it funded ended and debts related to that war were paid. But then, in 1916, the U.S. government reinstituted the estate tax for a fourth and final time to raise general revenue. In this case, the tax was meant to make up for revenue that was lost because of decreased trade. Revenue from trade taxes, which are called tariffs, had decreased because of World War I. But after the war, the tax remained in force. Why? Well, with the rise of modern corporations, politicians were concerned that wealth and power were being concentrated. So, taxes were collected on rich Americans in an effort to decentralize wealth. So these new conditions and these new ideas about the purpose of government led to the creation of new taxes. What's the idea behind the tax? In 1907, President Theodore Roosevelt argued that the estate tax contained what he called, quote, the progressive principle. The idea was that the tax should increase as income increases, and that the tax should increase in proportion to the recipient's remoteness of blood. The idea here was to make sure that the tax wasn't so high that it robbed people of the desire to work hard, and that it was set up so that close family could still benefit from a parent's financial success. So how exactly does the tax work? First, you have to find the size of your estate. To do this, add up your property, including your cash, your house, any stocks or bonds that you have, any businesses you own, and any life insurance policies that you hold. Then, you deduct anything you give to your spouse, any other taxes, debts, or casualty losses you might have to pay, as well as administrative expenses and gifts to charity. This is the size of your estate. If your estate is smaller than $5.25 million, then the tax simply doesn't apply to you. Now, people used to get around the estate tax by giving gifts throughout the course of their lifetime, usually to their children. So, in 1932, the government closed this loophole by creating a gift tax. The gift tax only applies to gifts over $14,000 a year, with a lifetime maximum of $5.25 million from one parent to one child. This means that a mother and a father could transfer untaxed up to $10.5 million to one of their children over the course of their lifetime. Now, you might wonder whether you will actually end up paying the tax. And the answer is probably not, even if you are very wealthy. We know this because if we compare the percent of people that died, which is that on the left there, to the percent of everyone that's actually filed for the tax, which is measured at the bottom, we can see that only about 1 in every 1,000 Americans currently file for this tax. That's that 0.13% you see. And what exactly is the tax rate that this small group of people has to pay? Well, everything up to 5.25 million, as we've seen, is exempt. If you have 10,000 more than the exemption level, which is the low bracket on the left there, you'll pay 18% on that $10,000. If you have 100 to 150,000 more than the exemption level, which is the middle bracket, you'll pay $24,000 right out the gate, and then 30% on whatever's left over. If you have more than $1 million over the exemption level, you'll pay $346,000 right away, and then 40% on whatever's left. Now, there's actually 12 tax brackets, but we're only looking at 3 in order to get an idea of how this works. Now these, the 18, 30, and 40%, are the marginal rates. They are not actually what people have ended up paying because of various exemptions and deductions. The average rate that's actually been paid since 1934 is about 15%. The rate that's been paid since 2000 is about 18%. So the highly publicized rates of 40 and 50%, and when people say the government is taking half of people's wealth, those are completely misleading statements. Now, if the tax exemption seems high, it's because it is. Even after adjusting for inflation, the current exemption level for the estate tax is higher than it's ever been. Now, the gap in the exemption level line, that gap in the blue line there, shows when the tax was repealed in 2010. And the continuation of the line under the arrow shows when it was reenacted in 2011. As a general rule, if you raise a tax's exemption level, it will affect less people, and therefore collect less revenue. So, knowing that there's a high exemption level, if someone were to ask us, is this tax a cash cow? Does it raise a large amount of money for our federal government? We could predict that the answer would be no, and we would be correct. In 2011, only about 3,000 estate tax returns were filed. As a result, it raised only $14 billion in 2012. Now that pales in comparison to the individual income tax, which applies to a lot of people, and thereby raised $1.1 trillion. Now for reference, the federal government's total income in 2012 was $2.5 trillion. But even though the exemption levels are at their record highs, it's important to note that this tax has never been a huge source of income for the federal government. Since World War II, it has only ever been 1 to 2% of federal revenue. This all teaches us that a tax with a broad base, even if it has a lower rate, will generate more revenue than a tax with a narrow base and a high rate. So we might step back and ask ourselves, why do we levy this tax? The Americans have been debating this for years. Conservatives tend to want to repeal the tax, which happened as we saw in 2010. Democrats have been fighting to make the tax structure less generous, to increase the rate and lower the exemption level. The Republican position can be summed up by Senator Mitch McConnell, who said, quote, "I've always felt the death tax was the government's final outrage, that you had to visit both the undertaker and the IRS on the same day." The Democratic view was stated by former Secretary of State Hillary Clinton, who said, quote, "The estate tax has been historically part of our very fundamental belief that we should have a meritocracy, that we do not want a system dominated by inherited wealth." So what are the trade-offs? Well, those who are against the tax say that the estate tax goes against economic freedom and penalizes hardworking families by double taxing them, once when they make their money and again when they try to give it to their children. Those who support the tax say that it makes up for a lack of a tax on profits from some capital gains, which make up more than half the wealth of many large estates. They also say that it encourages hard work by preventing recipients from inheriting massive fortunes. Yet, amazingly for both sides, there is no definitive evidence to support any argument about the effects of the tax on recipients. As a 2009 Congressional Budget Office study noted, the estate tax could have varying effects on consumption, saving, and work effort, depending on people's motives for leaving bequests to heirs. Consensus is lacking about which motives predominate, or even about whether people work and save more or less as a result of estate and gift taxes. Many private academic studies support the same lack of a conclusion, which means that the only real number that can be proven is that if we increase the tax, revenue goes up, and if we decrease the tax, well, revenue goes down. So what do you think? Do you think the estate tax should be increased or repealed? Cast your vote in our 1-second survey, and send this video to a friend who is likely to disagree with you. Then, have a civil conversation. Remember, we don't have to agree to be agreeable. And if you want to know the sources we used, check out our separate sources video on our YouTube channel. Thanks, and as always, have a great day.